Very good afternoon, learners. Welcome to today's session on capital structure. This is another topic taken from the subject called financial management, which is widely taught at different levels in commerce and management areas throughout the country. So, our topic of discussion for today will be capital structure. Okay. Now, this term, capital structure, comprises of two words. One is capital and another is structure. Okay, what do we mean by this term called capital and structure? The meaning of capital is something we have discussed in our previous sessions as well, that capital is something which is arranged by a businessman who wish to start a business. These are the funds which are required to start the business or to run the business very smoothly. Okay, it is like the blood for the business. To keep our business alive, we need these funds. So this is the funds which are required for the business to keep it running, to start the business, is known as capital. Then what do we mean by this word called structure? Structure is like artifact. Okay, it is like when one brick is placed on another brick, and then another brick is placed on this brick, one after another. When multiple bricks are placed on each other, a building will form. Okay, and a structure will form. So when multiple small components, small parts are taken together or joined together, they form a structure. Okay, the similar thing happens with the capital as well. The capital may be arranged from different sources. Okay, there are multiple sources from where the capital may be arranged for the business. But when all these components of capital, all of this capital which is taken from different sources are clubbed together, are taken together for a company, it will form a structure which is known as capital structure. So our discussion will be based on this particular topic today, which is called capital structure. So capital structure means the capital which is organized in the business, organized for the business, so that we can get the best results out of it. Now, when I say best result, what do we mean by that? Of course, the basic purpose of existence of the business is to earn profit. Okay, but it is not only about earning profit, but increasing the profit with time. Okay, so we need to increase the profit. So when I say that we need the best results out of our capital structure, we not only mean that we need to increase the profit with time, but it also includes reducing the cost of capital with time. Okay, ultimately it will also lead to increase in the profit. So when I say the word capital structure or optimal capital structure, it means that this is such a combination which will help us in increasing the profit, and at the same time it will help us in reducing the cost of capital as well. Okay, with this discussion we will start our topic, that is capital structure. So when I said this word capital, I also mentioned that the capital may be arranged from multiple sources, from different sources, and the sources of capital is broadly classified into two parts, that is from shares or from debentures. Okay, so shares, when I say the word shares, it may be equity share capital or it may be preference share capital. It is termed as only equity as well in some books. And when I say this word equity, it not only include equity shares, it will also include private equity, funds raised from venture capital, funds taken from angel investors, or maybe crowdfunding. So any type of fund or funds which are arranged from any of these sources can be classified as equity. So when word equity is there, then it means that fund which may be taken from any of these sources which I just now mentioned, is known as equity for us. Okay, and this is known as shares or the part of share or the source which is mentioned as equity share from which the funds are arranged for the company. Another source of fund which is popularly known as this word called debentures. It is also known as debt. This is like a loan which is taken from some outside firm or maybe bank or maybe some other person. So it is like loan, it is like debt which we have taken for some period of time, and after some period of time we have to pay this amount back. But during this time when we are using this amount, we have to pay a fixed charge called interest for using this capital. So whenever we have raised the funds in the form of loan which we have to repay, and during the course of utilizing these funds when we have to pay the fixed amount which is called interest, that means we are utilizing the funds from the source called debt. So these are broad two categories from where the funds, the capital for the business may be arranged. Okay. Then there may be certain factors. There are number of factors which affects the capital structure of the company. That means the combination of debt and equity forms the capital structure. But this capital structure may be impacted by number of factors. These factors are classified as internal factors as well as external factors. So when I say this word internal factors, it means these are the factors which are internal to the company. That means these are specific to a particular company, and up to a certain extent these factors are controllable. That means if it is possible for us to make certain changes in the factors and make the situation which is in our favor. So this is possible when there are internal factors which are impacting our capital structure. But at the same time, we have external factors as well. It is exactly opposite to the internal factors which are impacting the capital structure of the company. So these are the factors which are external to a particular company, particular firm, and these are beyond our control. This is something which is happening outside the company and it is impacting the capital structure of the company. Okay, so let us discuss these factors in detail one by one. So first, I would like to start with the discussion on internal factors. These are the factors which are up to a certain extent controllable, and by making minor changes in these factors, we are able to control or we are able to manage our capital structure in a proper way. Under internal factors which are influencing capital structure, we have the first one as size of the business. Okay, the size of the business, whether your business is small or your business is big, according to the size of business, you may decide what should be your capital structure. Whether your capital structure should comprise of only debt or only equity or mix of both. If your business is using mix of both, then in what proportion you need this? What should be the composition in which you need to use your equity and debt? So this may be dependent upon the size of business. If your business is small, it may be possible that you can raise the funds from debt. And in return of debt, you can easily pay interest for the period of time for which you are using the debt. But if your business is very big, okay, the size of the business is very big, it may be possible that the amount raised from debt is not enough for you. You may need more capital. In that case, you need to go for equity as well. Okay, then another factor that impacts the capital structure of the company is regularity and certainty of income. How regular, how certain your income is. Now suppose if you are using the funds which are raised through debt, debt also calls for fixed charge. That means if you have raised the funds through debt, you have to pay fixed amount in the form of interest. Whether you are earning profit or not, you have to pay this amount. And if your income is not regular, if your income is not certain, you may not be able to pay this amount in the form of interest. So this may call for bad reputation in the market as well. So we need to be thoughtful. We need to be careful when we are raising funds through debt as well. Okay, if our income is regular, then of course we can go for debt because we have source from where we can pay the interest amount. But if it is not so, then we have to think about it, whether we should raise the funds through debt or not. Then the next one is age of the firm. Okay, sometimes age of the firm also impacts the capital structure of the company. Now, if your firm is new in the market, there are hardly any investor knows about your fund. In that case, it may be difficult for people to come and give funds to you so that you can invest this amount in your business. But if your firm is old, it is renowned, it is working for quite some period of time, people are aware that what kind of business you are doing. Okay, in that case, it may be possible that you may go to some investor, you may go to bank, and they are ready to give you loan or they are ready to invest in your business. So depending upon age of, when the firm is getting older, people are knowing your firm. It will be easier for them to trust you, to trust your firm, and to put in their hard-earned money in your business. Okay, so this is how age of the firm affects the capital structure. Then desire to retain control. Now, sometimes as an owner, I don't want to dilute my control. Now, if I'm raising the fund through equity, I have to give the voting rights to my investors as well. Okay, so for taking any decision, I need to involve those shareholders for taking any decision in my firm. So sometime as an owner, I may not want to dilute my control. I want to be wholesale owner of the company. In that case, I will not go for equity. I will try and raise the maximum funds through debt. Okay, then my future plans. What is the planning for future? What I am expecting, what I am planning to do in future in my business. Whether I want to expand it, okay, or I want to introduce maybe a new product. So it also depends upon my future plan that what kind of capital structure my company should possess. Then operating ratio. Okay, operating ratio means operating efficiency of the company. How much input you are giving and how much output you are able to produce. Okay, it may not directly impact the capital structure, but yes, indirectly it impacts the capital structure. How? Because operating efficiency decides that what will be our profit. Okay, what input we are giving and what output we are able to generate. Okay, if the efficiency is very good, of course the profit will increase and it will impact our capital structure. Okay, then we have trading on equity. Okay, trading on equity is also known as the financial leverage. I will try to cover this topic in some future session as well, that what do we exactly understand by financial leverage. But for now, in brief, I want to share with you that financial leverage is something which may call a ratio of earning before interest and tax and earning per share. Okay, so in the very beginning of these financial management sessions, I talked about the purpose of financial management, the objective of financial management. I mentioned there that the purpose of financial management is to increase the wealth of our shareholders. So this trading on equity is a way through which we are passing the advantages to our shareholders. Okay, so that is why this component also decides that how our capital structure should be. Then period of financing, for how long we need the money. Okay, if we need the money for shorter duration, then of course we can go for debt because we need money, we need the capital for the shorter duration. But sometimes when we need the money for very long duration, maybe 10 years or 20 years. So in that case, it is good that if we'll go for equity. Okay, so that is why I can say that these are the factors which we can control, okay, which we can think about, which we can change according to ourselves, and these are the factors which are internal to the company, and these are the factors that are impacting the capital structure of the company. Now, coming to the external factors, something which is beyond the control of any company. Okay, amongst these is first one we have is capital market condition. What is the condition of capital market in a country? Okay, what is the situation of capital market? It also impacts the structure of the company because according to the capital market situation, we may have to readjust the ratio of debt and equity that we are using in our capital structure. Now, suppose the RBI changes the interest rate. Now, when the interest rates are changing, it impacts the amount of debt we may use in our capital structure, and accordingly, we have to change the ratio. Okay, this is one example that how capital markets are affecting the capital structure, and accordingly, we need to change our capital structure. Then we have nature of investors. What kind of investors we are approaching to. Okay, sometimes your business idea is so good, there are investors who want to instantly invest in your business. But sometimes it is difficult to convince our investors to come and invest in our company. Okay, in that case, we need to try again so that we can get those kind of investors who are interested in our business ideas, or we may also change our ideas according to the suggestions which are given by investors so that they can share or they can invest in our company. And this is something beyond our control. Okay, then statutory requirements which are given by or established by the government of a country. We have to abide by this statutory requirement. For example, banks cannot raise the funds from external sources other than getting it through issue of shares. Now, this is something which is obligated by law. Nobody has control on this. So, we need to be careful, and this is beyond our control. We cannot control this. Okay. Then the taxation policy. Okay. When we are raising funds through debt, we are generally, in India at least, we are getting advantage of taxation when we are using debt in our capital structure. So how supportive the taxation policy of a country, it also decides that what would be our capital structure, what proportion of debt we can use in our capital structure. Okay, so this is how taxation policies of a country also impacts the ratio in which we are using debt in our capital structure. Then policies of financial institutions. Okay, national financial institutions are coming up with different policies from time to time, like changes in monetary policy. There are certain banking regulations which are coming from time to time. Then how credit rating agencies are acting or reacting, and what are how individual financial institution policies are working, that what they are considering, maybe the size of the company, maybe the age of the company, the risk appetite of the company. Okay. And what kind of industry the company is operating in. So these may be the factors which an individual financial institution is considering before giving out loan to the particular company. So how the policies of individual financial institution are there in a company, or of that particular financial institution to whom we are approaching for funds. What are their policies? It is also impacting the capital structure of our company. And then cost of financing. Okay, now here we are considering two major sources of finances here. So the cost of financing by cost of financing is, it may be cost of equity or it may be cost of debt. Okay, so at what rate we are able to raise funds from these two sources, it also impacts the capital structure. Now, what rate is going on in the market? If the debt is available at cheaper rate, then I may opt for debt. Okay, and vice versa is also possible. So what is the cost of financing? What will be my overall cost of capital for raising the fund from these two sources? Also impacts my capital structure. So these were the external factors which are impacting the capital structure of any company. Now coming to this term called optimal capital structure. Now what do we mean by this term called optimal? Optimal itself means perfect. And when it is related to capital structure, what do we mean by this? It means that optimal capital structure, by optimal capital structure, we mean that we want such a capital structure at which we are able to increase our profit and reduce our cost of capital. Okay, in a simpler term, if I want to mention that this is the way through which we can increase the value of firm, and we are in a situation where we can reduce the cost of capital, overall cost of capital. Okay, the most economical and safe ratio between various type of securities is our capital structure. It is the mix of debt and equity which maximizes the value of company and minimizes the cost of capital. Now, when the word optimal capital structure is mentioned, there are certain features, there are certain essentials which must be there in your capital structure to make it a sound or a perfect or an optimal capital structure. So our capital structures should be drafted or should be prepared in such a way that it should be able to minimize the cost of capital, and at the same time it should be able to minimize the risk we are exposed to. And then it should be able to maximize the return and maximize the control as well. The capital structure should be flexible. That means in case the market scenario is changing, we should be in a position that we can change the proportion in which we are using debt and equity in our capital structure. And of course, our capital structure should be drafted in such a way, it should be maintained in such a way that it is fulfilling the legal requirements of the country. Okay, if we are not considering this last aspect, the first 4-5 aspects are useless. If our capital structure is fulfilling the first, say, 5 points, but not able to fulfill the legal requirements of the country, then first 5 features are useless for our capital structure to be optimal one. Okay. Coming to this term called valuation of share, which I mentioned while discussing the previous slide. So what is valuation of share? So valuation of share depends upon the earnings of the firm, and earnings of the firm depends upon the investment decisions, right? So the earnings of the firm are capitalized at a rate which is equal to the overall cost of capital. Okay, and this is done in order to find out the value of the firm, right? So we need to consider earnings of the firm. We need to capitalize this at a particular rate, okay, so that we can increase the value of the firm, and we should be in a position to reduce the cost of capital at the same time, so that we may have the optimal capital structure. Okay, therefore, the value of the firm basically depends upon 2 things, that is earnings of the firm and overall cost of capital. So overall cost of capital also means weighted average cost of capital. Now, when it comes to the capital structure, there are different theories which are proposed in past when capital structure is considered. So we have these 4 theories with us. First is net income theory, which is also known as NI approach. Then net operating income theory, which is also known as NOI approach. We have this traditional theory, and then we have Modigliani-Miller theory. Now, these 2 theories are basically relevant theories of capital structure. That means these 2 theories says that our valuation of firm depends upon our capital structure. If we are changing the proportion of debt and equity, it is impacting the value of firm. But the remaining 2 theories are irrelevant theories of capital structure. Why? Because these theories says that whatever your capital structure is, the value of firm is not going to change at all. Okay, so let us quickly discuss the first theory of capital structure, that is net income theory. And according to this theory, a firm can increase the value of firm and reduce the overall cost of capital by increasing the proportion of debt in its capital. So this theory says that when we are increasing the proportion of debt in our capital structure, we will be in position to reduce our overall cost of capital and to increase the value of the firm. And there are certain assumptions which are considered while dealing with this theory. It says that cost of debt is the cheaper source of finance as compared to cost of equity. Income tax is ignored for this theory. Cost of debt and cost of equity remains constant. That means whenever we are starting our calculation, whenever we are starting maybe a new business, so whatever cost of debt and equity is considered in the beginning, it will remain same till the time we are doing our calculation. Total requirement of the firm are given and constant. So based on these assumptions, we are going to calculate the value of the firm. Now, the value of the firm can be calculated by using this formula, which says that V is equal to E plus D, that is equity plus debt, or it may also be calculated using EBIT divided by KO, that means earning before interest and tax, which will be divided by overall cost of capital. Okay, so here E can be calculated by using the formula which is shown on the screen. E, that means value of equity, can be calculated by using EBIT minus interest, that means earning before interest and tax, minus interest, because interest is something we have to pay to the external party. This has to be divided by cost of equity. By this, we can calculate the value of equity, and debt can be calculated by dividing interest by cost of debt. Okay. So using these formulas, using this, we can calculate the value of debt. And by just adjusting the formula, we can also calculate cost of overall capital. So cost of overall capital, that is KO, can be calculated by dividing EBIT. EBIT can be divided by V, that is value of the firm. So an optimal capital structure is one that gives the maximum value of the firm with the minimum cost of capital. Okay, this may be understood with the help of this question quickly. So the expected EBIT of the firm is rupees 2 lakh, and it has issued equity shares with cost of equity at 10% and 6% debt of rupees 5 lakh. We need to find out the value of the firm and overall cost of capital, that is, which is also known as WACC. So here is the solution to this question. So in first part, in the very beginning, we need to calculate the value of the firm and WACC. So in first part, EBIT is given as 2 lakh rupees, which is given in the question. Interest can be easily calculated by multiplying 6% with 5 lakh rupees. So 5 lakh rupees is the amount of debt. It has to be multiplied by 6% because debt is raised at the rate of 6%. This is 30,000. So 2 lakh minus 30,000 will get the net profit, and our cost of equity is 10%. We just need to divide the cost of equity. We can calculate the value of equity by dividing the net profit with cost of equity. That means 1,70,000 that we get as net profit, it has to be divided by cost of equity, that is 10%. So our value of equity, that means our E is equal to 17 lakh. Debt is already given in the question, which is 5 lakh. By adding E and D, equity and debt, we get the value of the firm, which is V, 22 lakh. Now by using this value, we just need to calculate WACC, that is overall cost of capital. EBIT is given as 2 lakh rupees. It is given in the question. V is something we just now calculated, that is 22 lakh. EBIT divided by V, that means 2 lakh divided by 22,000 will give us 0.09, that means 9%. So this is the first part of the question which asks for the value of the firm, that is 22 lakh, and this is the second part of the question which asks for overall cost of capital, this is 9%. Now the structure of capital is changing in the company, and since the structure of capital is changing, it says now the debt is 7 lakh instead of 5 lakh, but the rate at which the debt is raised is same. So in this case, EBIT will remain same, that is 2 lakh rupees, but our interest will be calculated on 7 lakh rupees instead of 5 lakh rupees. So our interest is 42,000. 2 lakh minus 42,000 will give us net profit, which is 1 lakh 58,000. Cost of equity will also remain same, that is 10%. And using this, we can calculate the value of equity. So we have our net profit with us, which is 1 lakh 58,000. It has to be divided by cost of equity, that is 10%. With this, we get the value of E, that means value of equity, which is 15 lakh 80,000. Debt in this case is 7 lakh, which is already given, and equity plus debt, these two values when we are adding, we get this value, which is our V, 22 lakh 80,000. Okay, so again, this is the first part of the question. Second part, in second part, we have to calculate WACC, which is 2 lakh divided by 22 lakh 80,000. That means 8.7%. In third part, the debt is reduced from 5 lakh to 2 lakh at the rate of 6%. Again, EBIT is 2 lakh. Now, 6% of 2 lakh will give us the interest amount, that is 12,000. Net profit is 1 lakh 88,000. Now, using this amount, we can calculate E as we have calculated in other parts. So, our value of E is 18 lakh 80,000. Our debt is 2 lakh. So, which will give us the V, the value of firm, which is 20 lakh 80,000. Using this, we can calculate WACC, which will come as 9.6%. So this is how we can see that how the change in debt is changing the the overall cost of capital and value of the firm. Now, this is the conclusion of this question. So you can see that when we are changing the capital structure, so in first case, we have debt as 5 lakh rupees. So in second case, we have increased the debt to 7 lakh rupees. In third case, we have reduced the debt to 2 lakh rupees. And it is impacting our capital structure. Our KO is 9% in first case. When we have increased the debt, the KO will increase to reduced to 8.7%, and when we have reduced the debt, the KO has increased to 9.6%. So this is how we can say that the NI approach is impacting the capital structure. How the change in debt, proportion of debt in a capital structure is impacting cost of capital and value of the firm. So this is all from my side for the day. We will continue this session in one of the future sessions when we are going to discuss another 3 theories of capital structure. Thank you and happy learning.